In the autumn of 1907, the American financial system trembled on a knife's edge. There was no Federal Reserve, no central authority prepared to inject emergency liquidity, no institutional backstop capable of calming panic with the stroke of policy. When fear spread, it spread unchecked. And in October of that year, fear began moving faster than money. The United States was, at the time, the fastest growing industrial power in the world. Railroads stitched together distant regions. Steel mills roared day and night. Oil, coal, and banking fortunes reshaped cities. Corporate America was consolidating into vast trusts and holding companies. Wealth accumulated rapidly. Optimism was everywhere. But beneath the expansion lay instability. The American banking system was fragmented. Thousands of independent banks operated across the country, loosely connected and unevenly regulated. New York City stood at the center, acting as the financial hub where reserves flowed and credit was extended. Yet there was no central bank to coordinate monetary policy or provide emergency lending during crisis. Trust companies had become the new giants of finance. They were similar to banks but operated with fewer restrictions. They often held lower reserves relative to deposits. They invested aggressively in securities and speculative ventures. Their growth was explosive in the early 1900s because they offered higher returns and more flexibility than traditional banks. As long as markets climbed, this structure seemed efficient. But markets depend on confidence. And confidence, once shaken, is merciless. The immediate trigger for the panic of 1907 was a failed speculation in United Copper Company. In October, a group of speculators attempted to corner the stock, believing they could force short sellers to buy shares at escalating prices. The plan unraveled almost instantly. Instead of soaring, United Copper stock collapsed. Within days, it lost nearly all its value. The failure might have been contained to a single failed gamble, but several banks and trust companies were linked to the speculators. Rumors began circulating about their solvency. Depositors grew uneasy. Withdrawals increased. One of the most prominent institutions affected was the Knickerbocker Trust Company, then the third largest trust in New York. When its president was forced to resign due to connections with the failed speculation, panic intensified. Depositors lined up outside its headquarters demanding cash. On October 22, 1907, Knickerbocker suspended operations. The sight of a major trust company closing its doors sent shockwaves through Wall Street. If Knickerbocker could fail, who was next? Trust companies relied heavily on short-term deposits to finance longer-term investments. If depositors demanded their funds simultaneously, even solvent institutions could collapse. Fear spread rapidly. Depositors rushed to withdraw funds from other trusts. Banks grew reluctant to lend to one another. Interbank lending rates spiked. Liquidity evaporated. The New York Stock Exchange saw wild swings as investors dumped shares in desperation to raise cash. The American financial system was experiencing a classic bank run. In earlier decades, similar panics had occurred in 1873 and 1893. Each time, the absence of a central bank had forced private financiers to coordinate rescues. In 1907, attention once again turned to one man, J.P. Morgan. John Pierpont Morgan was 70 years old. His presence was imposing, his authority unquestioned within financial circles. He had orchestrated railroad reorganizations, engineered the creation of U.S. Steel, and played a pivotal role in stabilizing markets during prior crises. He commanded respect not through public office, but through influence and capital. As panic deepened, Morgan retreated to his private library on Madison Avenue. There, beneath dim lighting and towering bookshelves, he convened the most powerful bankers and financiers in the country. For days, they reviewed financial statements. Morgan insisted on full transparency. Institutions seeking support were required to open their books. Teams of accountants worked through the night assessing which firms were solvent and which were beyond saving. Morgan understood something essential about panic. Hesitation fuels collapse. Confidence requires decisive action. When trust companies faced runs, Morgan organized pools of capital from major banks to provide emergency funding. When the stock exchange teetered due to lack of credit, he coordinated a $25 million injection to keep trading open. That sum, enormous at the time, was enough to prevent the exchange from closing. At one critical juncture, Morgan locked several bankers inside his library until they agreed to contribute funds to stabilize a failing institution. He refused to allow them to leave until collective action was secured. The fate of the market depended on unity. Meanwhile, the crisis spread beyond New York. Regional banks across the country faced withdrawals. Businesses struggled to access credit. Factories reduced output. Economic contraction began to ripple outward. Clearinghouses issued emergency loan certificates, allowing banks to settle balances without using scarce cash. These certificates functioned as a temporary substitute for currency within the banking system. It was an improvised solution born of necessity. Yet the most dramatic moment of the crisis came when the brokerage firm Moore and Schley faced imminent collapse. The firm had borrowed heavily against shares of Tennessee Coal, Iron and Railroad Company. If forced to liquidate, the sale of those shares could trigger further market decline and deepen panic. Morgan devised a solution. U.S. Steel would acquire Tennessee Coal and Iron, stabilizing the collateral and preventing liquidation. But such a merger raised antitrust concerns. Approval from President Theodore Roosevelt was required. In an extraordinary episode, Morgan's representatives met with Roosevelt to secure authorization. The president agreed, recognizing the systemic risk posed by inaction. The acquisition proceeded. The immediate threat subsided. By early November, the panic began to ease. Markets stabilized. Trust companies reopened under stricter scrutiny. The economy, though shaken, avoided total collapse. Morgan's intervention had succeeded, but success came with an unsettling realization. The stability of the world's leading industrial nation had depended on the judgment of one private banker. There had been no public institution capable of performing the role of lender of last resort. Instead, private authority had substituted for central banking. Public opinion was divided. Some newspapers praised Morgan as a savior of capitalism. Others expressed alarm at the concentration of financial power in private hands. The spectacle of aging financiers determining the fate of the economy behind closed doors unsettled many Americans. The panic of 1907 exposed structural weakness. The American economy had grown too large, too complex, too interconnected for its outdated financial architecture. Industrial expansion had not been matched by institutional reform. In 1908, Congress established the National Monetary Commission to study foreign banking systems and propose solutions. Senator Nelson Aldrich led delegations to Europe, examining the Bank of England and the German Reichsbank. These central banks had mechanisms to inject liquidity during crisis, preventing widespread bank runs. The question confronting America was not whether reform was necessary, but how it should be designed. Debate was fierce. Populists feared a central bank would serve Wall Street interests at the expense of farmers and workers. Bankers worried about government overreach. Political factions argued over structure, governance, and authority. Behind the scenes, influential bankers and policymakers met secretly at Jekyll Island in 1910 to draft a blueprint for reform. The plan evolved over years of negotiation and revision. Finally, in 1913, under President Woodrow Wilson, the Federal Reserve Act became law. The Federal Reserve System was created with regional banks overseen by a central board. It was empowered to issue currency, regulate member banks, and provide emergency lending. The Panic of 1907 had directly inspired its creation. The new system aimed to prevent the kind of liquidity crisis that had paralyzed markets 6 years earlier. By centralizing reserves and establishing a lender of last resort, the Federal Reserve sought to ensure that panic would not again spiral unchecked. The emotional arc of 1907 remains striking. A booming nation, confident in its progress, confronted sudden fragility. A private banker stepped forward to impose order. Disaster was narrowly avoided, but the rescue illuminated a deeper truth. Modern capitalism required institutional safeguards. The crisis also revealed the psychology of finance. Panic spreads not solely through insolvency, but through fear. Depositors withdraw because they believe others will withdraw. Markets collapse because participants anticipate collapse. Confidence is both intangible and indispensable. In this sense, the Panic of 1907 was not merely a financial event. It was a lesson in collective behavior. Over a century later, its echoes remain relevant. Financial systems continue to depend on liquidity and trust. Central banks have since intervened during crises, including the Great Depression, the 2008 financial crisis, and global shocks beyond. Each intervention traces conceptual lineage to the realization forged in 1907. J.P. Morgan did not create the Federal Reserve, but his actions demonstrated why it was necessary. The crash that created the Fed was a paradox. It showcased the power of private coordination while simultaneously proving its insufficiency. It preserved the system in the short term while transforming it in the long term. From that autumn panic emerged a permanent institution designed to stabilize markets when confidence falters. The Federal Reserve would not eliminate crises, but it would ensure that no single individual would again bear sole responsibility for rescuing the American financial system. The Panic of 1907 stands as a reminder that economic strength requires structural resilience. Growth without safeguards invites instability. And when fear overtakes markets, decisive intervention becomes essential. In the dimly lit library where Morgan once convened bankers, decisions were made that altered the trajectory of American finance. The rescue succeeded, the panic ended. But the true legacy was not survival, it was reform. One man saved the system, and in doing so, he convinced a nation that it should never depend on one man again.